It's really a pleasure, and you know, Ann and I have known each other for longer than either of us want to admit. And what we've decided is we're going to have a conversation for a while. We're going to let you guys listen in. All right? Hopefully you'll learn something, and then we're going to open it up for back and forth. And I think you might learn some things that will provoke a very interesting conversation among the group. You know, I wonder whether now we've got some of these people in the room on false pretenses. Because when we sent out all the advertising for this program, you know, we were pitching it like there was this really big battle. All right, and not only was, you know, Carl Icahn trying to wrestle a few stray billions of dollars out of the coffers of Apple Computer, but you had a group of shareholders, right, often called activist shareholders, basically going, Carl, you're wrong. All right, why don't you leave Apple alone? And Carl and some other activist shareholders going, well, they have the money and we want our piece of that money. Let's hit rewind for a moment. Let's talk about what this battle was all about, how long it's been brewing, the dimensions of the debate, and then what is it that happened, right, just this morning. So let's take, you know, step one. What was the state of play until this morning?
Until this morning. I feel as though we've sort of come in on the third reel. You all know what happened, the happy ending this morning. Did anybody not read the papers this morning or read online? We know that Carl Icahn has decided to withdraw his proposal, which we're delighted that reason has prevailed. And this was an interesting episode because it's the second year that Apple has faced an activist. Last year, and I think this is originally what we thought we'd come and talk about. Not one activist, but two that we can discuss. So here's the biggest company in our portfolio, sitting on a huge amount of cash, which is a problem we want to have, isn't it? You want your companies to be so successful, they've got more cash than they know quite what to do with. So the debate of the day is what to do with the cash, not how to stay in business. So we have this hugely successful company. Here's CalPERS, Apple's the biggest company. CalPERS, I think, is the biggest fund in the United States. So we are comfortably in excess of $250 billion of assets. But this money must be invested for the best part of a century. So our duty, our fiduciary duty, is to pay pensions, which is an important and mighty responsibility in itself. But we must still be able to pay pensions in 50, 75 years. This isn't something where what's happening now or next week or even next year is really of a great deal of interest. So our board in October took the bold step of deciding to issue a set of investment beliefs. Now, you might think this is a statement of the blinking obvious, but if you're a fund our size, it's helpful to step back and say, well, where do we think the money comes from? Every dollar that we pay to our pensioners, 66 cents, comes from investments. And we have to think that might be true now. It was a lot more before the financial crisis. We were overfunded in 2007. But think about what are we looking for so that that money can still be paid in 50, 60, 70 years' time. So first of all, we're thinking about where does value come from? And then we're thinking, well, what are the risks that are attached to that? So the reason of having a little preface on this is just to step back and explain what is our day job. What do we have to be paying attention to? Because it explains why Mr. Icahn and I had some different points.
So then dive in just a little bit here. You know, one of the models at Apple is think different. All right, and
that's ungrammatical.
It's very ungrammatical. Right, that's exactly right. But Steve Jobs.
Not different.
Understood. Do you feel bad or do you feel badly?
I think grammar should not be different.
I mean, all right. But what was interesting is Steve Jobs actually knew what the correct grammar was. This was brought to his attention.
Oh, and
he decided that he needed to be different.
All
right?
But not different.
No, he needed to be different. And I just want to, are you making me feel bad or badly now?
Only you can tell.
I think I can.
And you'll feel better soon.
I beggarly feel better. So, when Apple says think different, are you suggesting that the same is true in the shareholder community?
Yes.
That you've got one group of shareholders who say basically, look, you're stuck with us forever. We can't leave you.
Yeah.
All right? We need to have a very long-term focus. And then you have other shareholders who are, you know, happy to flick in and out. We'll build up a position, and if we can get a good short-term return on that position that drives our IRR, that makes it a lot easier for us to go out and raise our next fund. And if you say that we've got to be in a position for 10, 15 years, that's totally useless to us, because I've got to close my fund and I've got to distribute the money, you know, in a 5-year cycle. So talking to me about, you know, a 15-year investment horizon is like playing music to a deaf man. I don't care. Are you suggesting that that kind of difference exists?
Yes, I mean, in the whole episode with the this year's activist fund and last year's activist fund, we've said, well, you know, the world was designed with the corporation that there would be shareholders, and each shareholder has an equal right to the residual risk and to the returns in the company. But actually, we're in a situation now where shareholders are different and are beginning to think differently. Because we would say, just to answer your point, Professor, you have to let me answer, otherwise I would be a good student if I can't. Is that there are owners, and I think that's CalPERS, we think we are owners, and all the responsibilities that come with ownership. There are traders, and these are the people who bring liquidity to the market. That's important, price discovery and getting in and getting out, that's all marvellous. And then there are raiders, and that's the community of activists who are able to exploit and to arbitrage and to take advantage of short-term dislocations and pricing. So we think the most important thing for the economy and also for companies is that owners behave like owners with all the responsibilities that requires. And remember that we're investing in companies. We're not investing in trading opportunities or arbitrage opportunities. And once you remember that there are companies underlying that value creation, and pay attention to the idea that companies have to have a strategy. They have to have capital discipline. They have to have a board of directors that's competent and accountable, and start to think about your responsibilities providing financial capital into that corporation. The market is an intermediate form. It's a way to enter and exit with your capital in either greater or lesser form, depending on how clever you think. But if you're an owner of a corporation, it's a very different mindset, and a very different way of thinking about governance.
And you've said so many different things, there's so many directions I can go, but since we're at a university, I'm going to try to go this sort of highbrow kind of approach here. And that's inadvertently or not.
Yes.
You basically put down a challenge to essentially all of our tenured faculty in the finance department over at the business school, and a couple of Nobel laureates here again. Because a lot of modern market finance would say that, gee, markets are reasonably rational over time. If you're not going to have, any misvaluations that you're going to be able to take advantage of. So if Carl Icahn has some technique or some proposed transaction, and if it leads to a situation where the stock price goes up by a statistically significant X%, even if it's measured over a short time window, that can't happen unless there's a belief that it's going to lead to a longer return, because you've got another bunch of rational investors who are going to be buying the stock price at this higher price. And what you're suggesting is that's wrong. All right, and that we shouldn't pay attention to some of these short-term gains because they can act like short fixes that give you a rush and they make you feel good for a short period of time, but they're not nutritious over a longer horizon. And the finance specialists would look at you and would say, Anne, how can you tell which is the sugar high and which is the actual change in fundamental strategy that's going to lead to positive long-term returns? That's the challenge that we're waiting for.
Yes, a couple of thoughts here. When I was taught economics many years ago, I had a wonderful professor at St. Hilda's College, Miss Watts, and she had been part of the post-war national government and had been involved in that whole period of time. And so she was a working economist. And I remember asking her why we had the factor X in our equations. And what was X doing there on both sides? It was the only way the equation was balanced if you looked at real life. And she said to me, Anne, my dear, think of X as being human nature. So in other words, economics works so long as you've got no human beings involved. And I think that's probably about right. And there are branches of economics now, and Nobel Prize-winning economists, who acknowledge that markets represent a sum of human activity, which therefore involves irrationality. And so we know full well that markets are efficient until they're not. Yes? Was that the financial crisis? At what point was it efficiently going, defying gravity, and then efficiently wiping $70 billion off our portfolio? So with that in mind, we have a real interest in thinking about the system and what makes markets function better than an average group of crazed investors high on sugar at your sugar rush party. I'm not sure what you're selling outside. I hope it's not.
This is Silicon Valley.
It's Silicon Valley.
We hope it's just a sugar rush.
It's just a sugar
Valley.
rush, okay. But if we think about what is it that will foster market stability, we know, for example, the flow of information. So the pricing, fair value, relevant information, this is all highly important to CalPERS. So we have a work stream where we actually have a real concern about information coming to the market. So think about something like derivatives. So according to the now RIP Gary, not only in professional terms, Gary Gensler at the CFTC, he estimated before he stepped down that for every $1 in the real GDP, my world of Miss Watts, when I used to learn about economics and was taught those things, there's $1 of that stuff, there's $600 of derivatives out there. And there's no internationally agreed standard for the, to disclose those. We have no agreement on financial instruments. And so you've got 600 to 1 ratio. This is off the balance sheet. Furthermore, it's not even regulated. And then we start to think, gee whiz, well, how are markets going to deal with that? So markets require a number of factors. First of all, we have to accept that there are conflicts of interest in markets. We need regulators which can consider externalities. I mean, think about something like climate risk, where it's rational for every single coal company to burn every little bit of coal and every bit of drop of oil, and meantime, the temperature on the planet will go to hell in a handcart. That's a systemic risk. It's what economists call a tragedy of the commons. So we need regulators, and markets don't just exist on their own. So Adam Smith had this lovely idea of the invisible hand. You would be in the market selling your leather breeches, I'd be there selling my goat skins, and we'd agree a price. And somehow the invisible hand was really essentially the net sum of all the negotiations between people on price. He also assumed that people had a huge altruistic streak. His first book was The Theory of Moral Sentiment, before he wrote The Wealth of Nations. He was a moral philosopher first and an economist second. So he had a rather benign view of human nature. So now we're in a system where markets are global. They're driven by an amount of liberal flows of capital at high speed because of technology. We have regulation, which is rooted in a rather 19th century construct of the nation state. And we've had innovation and advancement in financial markets such that they are coming to have a life of their own. And I think the fear of all of this is that the financial sector is now the single biggest section of the economy. But it's not a productive sector in the sense that we all understand the real economy to be. So how we can, as we have said, I have said with my staff, is putting service back into financial services, getting to the point where the financial system serves the economy, must be one of the outcomes of actually getting a better governance structure overall. And I'd like to introduce James Andrus, who's our new portfolio manager, who started today, and this is his mighty responsibility, is to develop our strategy in this arena. So that's my answer on the market.
We could go in 55,000 different directions.
I thought we just did it.
Well, we could go 55,000 more different directions. And what I'm going to try to do is bring the conversation back to the immediate issues, Apple, the decision about Apple, and what we can learn about the current status of the shareholder community, and the evolution of shareholder governance, and how that might be related to a very different political dynamic that's evolving in the shareholder community. So let's hit rewind again for a second. Apple's holding about $160 billion. how do you make the determination that that's fine? And if Apple were to go to 300 billion or 500 billion, would you still say that that's fine? Or is there some point at which you say, now wait a minute, now that's too much? And how do you decide?
Mm-hmm. So let's frame it differently. Companies grow from their retained earnings. I mean, maybe the markets were designed with the idea that companies would be issuing share offerings and financing, but actually the facts are companies retain earnings to grow. If you're in a sector like technology, you've got things moving very fast, and innovation is your only suit. It's the only game you can play. And, you know, the market is littered with companies riding high and then falling. I mean, look, even Apple has gone through this itself. It was bailed out by Microsoft not so long back. So the question about what is the right amount of money, I don't think is something for which there is a simple bit of arithmetic to be done. It's not, you know, how many angels can dance on the head of a needle. We actually have to think about the reason that we have a board of directors. Now, I can sit down with you and have a few gin and tonics, and we can add up a few numbers and say, well, we think they should give back $150 billion. That's what CalPERS said. I said, maybe not. Okay, how about 50? And the board has already got something in place. So what's happening here is shareholders, I think, have an important job, provide the capital, but then their job is to make sure that the board is competent and independent and in a position to oversee management strategy. If you think that you've got something to contribute at that level of detail, you should run for the board. I think our job is to hold the board accountable, and if we lose confidence in the board, we don't think they're on top of their game, we think they're stagnant or they're not making good decisions, we should be able to hoof them out. So that then allows me to remind everyone that the way that we started this whole world of CalPERS, the big pension fund, and Apple, the big company, was because Apple did not have proper elections for directors, not proper in the sense that we think. They did not have majority voting. And this is a quite normal procedure in the United States, and not many other countries, but the US primarily, where even if directors stand for election and votes are withheld, the person, should they receive one vote in favour, votes are withheld, do not count for anything, and the person can just stay in office. So in other words, I think for the shareholders, the most important right is the ability to hire and fire the board. We also at CalPERS think we should have the ability to put candidates forwards. In extreme circumstances, you actually want to put in fresh talent, but that's proxy access, that's another thing. If the board of Apple was sitting on the $300 billion and had not
It's 160.
No, I said if.
Okay.
It's conditional preposition.
Right.
If they were sitting on $300 billion and the board was not in a conversation with its investors and it did not have a plan for how to return that money in a reasonable way over a reasonable time, and was not making sure it was retaining sufficient funds either for acquisitions that may look attractive or innovation that's essential to the company's future, then we're in a very different conversation. And I think if Apple was just sitting there on a big pile of money without a plan, and Carl Icahn, or last year it was David Einhorn, roll along and say, good morning, that money is just sitting there doing absolutely nothing for anybody, and we think you should return it to shareholders. I think at that point you'd probably find there'd be huge support. I would be amazed if it took an activist investor to bring that issue to the table, because this is part of an ordinary conversation with the board of directors. Long-term strategy, capital discipline, who's on the board, what's the plan? And if you're confident with that, then I think you actually have to allow the board to have some judgment over the precise amount, the precise mechanism, and the precise timetable.
So obviously...
So do not have a dog and bark yourself.
So obviously Apple has persuaded you that they have a rational plan with what to do with the $160 billion.
Do you not think they have a rational plan?
Oh, I think they probably do, but I don't get to cast as many votes at the Apple shareholder meeting as you. So I think it's much more important, not only to Apple, but to the rest of the world, to have an appreciation of your appreciation of what constitutes a rational plan.
An appreciation of my appreciation.
Yes, because an
of the
appreciation
rational
of my appreciation would be a depreciation.
So, Apple said in 2012 that it would return $100 billion to shareholders. And it would be a mix of, it had an authorization for, 60 billion that would come through a share buyback plan. And the timing of that would be decided by the board. Now, actually, we agree. If you look at and that's, I know what professors do, if you look back at the record of share buybacks, it's mixed at best. Could try harder. The timing of this is really fiendishly difficult. Boards often get it wrong. Management often get it wrong. And it doesn't always, do anything much for the long term. Now, if you're about to sell a short-term trader, share buybacks super duper. If you pay tax, it's also advantageous relative to dividends. If you're a long-term owner, like we are, we're more interested in what's happening to the capital for the company's long-term future. So if you kick up the share price for a short period of time, it's not clear to us what we've derived by way of benefit. What we're more interested in is how is that capital being deployed to ensure that the company is going to keep its competitive position. And for Apple, that really means innovation. And, if did any of you read Carl Icahn's first and second letters to shareholders, in which he claimed that the wrist is an attractive part of the body, and that once this was recognized, this was a zone for Apple to focus upon in its new products. I find this quite extraordinary. If you're like me saying, Tim Cook, have you thought about the ankle and the options for new products? Really? Is that the level of the dialogue about innovation? I think we have to accept that if the board lacks competence, lacks imagination, lacks diversity, that's a way to ensure that quality discussion, then really we ought to be hoofing out directors and bringing in fresh talent. I actually, here we are at CalPERS, we own the best part of 10,000 companies, a piece of 10,000 companies in 47 markets. And at what point do I become an expert on innovation? It's not my job. It really is not my job. It would be like me saying to my dentist, I really don't think that root canal should be done quite that way. I have a view. I'm paying for this, so I think I'd like to just have a word about the way you go about this procedure. Well, I think it's a little bit the same with the providers of capital. You have to hold the board accountable. And if you're not satisfied, then you have to go in and actually... I would always much prefer that the conversation is about the board. I really feel most uncomfortable with shareholders cooking up financing plans, lobbing them in, and hoping for a quick kick on the share price. This, to me, is not sustainable investment, which is really what we need.
Okay. So basically your question is, can I trust these people on the board?
Mm-hmm.
Do I think they have their oars in the water, and they're obviously much closer to the issue than I, as an outside stockholder, can possibly be?
Yes.
Even if I hold tens of billions of dollars and have my own investment staff and team, at the end of the day, the question is, do I trust these ladies and gentlemen on the board to be appropriate stewards of the capital that we've given them?
Yes.
And unless their decisions are out of the zone of reasonableness, we're going to defer to them.
Yeah, or the performance is dreadful.
Sure.
So it's two other things to add to this. Something else in CalPERS' development of these investment beliefs was, number one, our liabilities must drive our investment strategies. Yes. Number two, we have a long-term horizon, which is both a responsibility and an advantage, because that actually gives us ability to be counter-cyclical. It allows us to sit there through long periods when things aren't popping and you don't need to trade. We can stand some illiquidity. But it's also a responsibility, and we say in those investment beliefs, it's up to us as long-term owners to engage with our managers and with companies and with public policy makers to make sure we've got an environment in which in long-term things can thrive. Mm-hmm. But the other thing that we say in these investment beliefs, which is really important, is that value comes from three forms of capital being well managed. And that's financial capital, which is the current debate about Apple, but it's also physical capital, and that's the engagement that we're having at the moment with others through the Carbon Asset Review on climate risk, and human capital. And we're in an engagement strategy with global retail companies about what's happening in their supply chain. And that was all triggered by the tragedies in Bangladesh. So if we think about human capital, physical capital, and financial capital, and we hold boards accountable for managing those three forms of capital, we feel we've got a setting in which we can really talk about long-term value creation. And that is worlds away from what does the share price look like in the morning versus yesterday.
Now, when we talk about shareholder influence over boards, there's really been a revolution in the market over the last several years, and most people are unaware of that revolution. And it comes about because of a combination of the concentration of assets within a smaller group of asset managers, and the fact that there has emerged a relatively small group of bellwethers, all right, where if you can get 5 or 6 institutional investors or in a particular category to support or oppose a particular position, the probability that that position will prevail goes up very, very significantly. So just to give an example of that point, we run a group here. Rich Kopis heads the group called our Stanford Institutional Investors Forum. We typically meet in a relatively small room over at the faculty club. We get about 25 people in the room, and we take a tally, and with 25 people, we have about $14 trillion in assets under management represented in the room. And just to scale that, all right, obviously it's a comparison between, flows and stocks, and that's wrong. But the entire United States GDP is $14 trillion. So
Problem solved on the economy.
Well, there you go. Exactly.
All
we got to do is we got them in a room, and all I got to do is empty their pockets.
Just say invest, lend to small businesses, credit flows.
Oh, no, I was actually thinking of picking their pockets.
Oh, you're just stealing. Stealing. Okay.
I got $14 trillion in the room.
Well,
you can leave $1 trillion behind. I mean, come on. You won't even notice it's gone. Right. It's exactly right. But the reality is that shareholdings are now so concentrated, and influencers in the process, whether it's to be, entirely candid, and it's you, all right, you individually are a huge influencer in this process, or whether it's an organization like ISS, much more controversial, but clearly it's an influencer. There are probably no more than 5 or at most a dozen big influencers in this space that can really help swing big issues and big votes. And what Carl did is, he basically said, look, I've achieved everything that I'm going to achieve, but he withdrew his proposal only after you came out against it, after New York came out against it, all right, after I believe PIMCO came out against it, and after a group Warren Buffett, a group of other influencers.
That'll do it, actually.
Yeah. So it was a situation where lots of other credible people stood up and said, Carl, we don't agree with you. And rather than go to the vote and be thrashed in public, because his position probably would have gotten a relatively small
But we don't know that.
Well, what do you think would have happened?
I don't know, and I think the reason we have annual general meetings and extraordinary meetings is so that proposals can come forwards and they can be voted on. And I think that's actually a really important feature of the corporate system. And I know when CalPERS puts proposals forwards, it's typically because we cannot agree with the company. So let's stay with our friends at Apple. We talked to them, I guess the first year I was at CalPERS, we started to say, okay, well, let's just take big companies and start talking about majority voting, because if we can get the board right, a lot of other good things will follow. And Apple, first of all, was not in the habit of talking to shareholders at that point. Had other things to do, and it didn't involve investors. So that was one thing. And secondly, they considered that some quirks of California state law made it really tricky for them to introduce majority voting. And there is a fair point there, and at some point we should go and try and deal with that little wrinkle. But it is only a wrinkle. It's not an insurmountable barrier. So what we did was actually file a proposal at Apple to say, please, we would like majority voting. And the first time it was voted on, there was 70% of the vote was in favour, at which point the company was like, okay, interesting. Nothing then was done. We came back the next year, and 80% was voted in favour, at which point Apple said, we get it, okay, yes, everybody really, really, really wants this to happen. The next year, they put, this last year, put forward new articles of association, which included this. and other reforms. And then Mr. Einhorn didn't want one of those reforms. He wanted the board to keep its power to be able to issue what's called blank check preferred stock. It allows them to issue non-voting shares without going to all the shareholders for approval. And that would have been a convenient way, in his opinion, to pull cash out of Apple. He went to court to have the vote suspended under an injunction. It was a great drama. And this year, they're back again with their articles in 3 little neat and tidy pieces on 3 separate resolutions. Majority voting's coming back, and then there's the Carl Icahn. Now, if Carl Icahn had the courage of his conviction, the proper thing to do is to come to the meeting with the proposal and let everybody vote. I mean, really, that's what the system's for. And I think, the world, and I've said it, my daughter, who's here, Eve, said to me, Mummy, you went on the television and said, all this twittering and tweetering and Facebooking, we should just sit down and talk. And she explained to me that twittering isn't something you can do on social media. But anyway, apologies if I've accused anybody of twittering. But it seems to me that this world of trying, communicating through social media and not just sitting down round a table and trying to sort things out. If you can't sort things out, then fair enough. File a proposal, let everybody vote upon it, and if everyone agrees, probably the company's going to eventually come around to seeing things your way, and you'll solve the problem. So issuing this big proposal and then having all the drama and then withdrawing it, really, I mean, I can't predict what the vote would be. You know full well what CalPERS thinks about it, and what other investors think at this stage. But really, it could have simply gone to the vote, and there could have been that debate at the meeting. That would have been completely fine. That's what the system's for.
I don't know. Not many people say that Carl lacks the courage of his convictions.
No, but the way I was brought up.
If you put up a proposal, you should stand behind it. Indeed. And don't fold your tent and run from the field of battle when you realize you're about to get thrashed.
I couldn't possibly comment.
There you go. We've only got about 18 minutes before the fire alarm goes off. So why don't we open it up for questions from the audience? There you go. What a great idea. Well, the camera's running right over there. No, nobody will notice.
That was a joke.
So let's go to questions from the audience.
Hi. Well, to me, it seems like buybacks are more or less fishing with dynamite. And I'm wondering, when is fishing with dynamite appropriate? It seems to me that, you've got dividends, you've got, you could do something like Google Ventures where you're putting all this money into startups. You could do a lot of R&D. But when are buybacks appropriate?
Anne?
Well, how long is a piece of string? Yes, if you'd like to answer that, we could move straight to your buyback question. This is simply a technique. It's a piece of financial engineering. In the same way, what's the appropriate amount of leverage? How much borrowing should you have? What would be the right amount of interest? And what tax should Apple pay when it repatriates money from overseas? I mean, the point is that there's no number. There's nothing I can do on my Spike abacus to give you that number. What you want is that the board will sit down, reasonable, decent, informed, independent, diverse group of people will sit down and work out the balance, because they've got a wide range of shareholders. Some shareholders, probably the trading community, and some in the raiding community, for whom that share buyback and a kick in the share price actually means a lot. If you're just holding on to your shares and you're an owner, dividends, particularly for us, we're tax exempt, we're utterly neutral, agnostic on the tax yes and no in a particular mechanism. So, and the tax situation is particularly complicated as well. So what I would want to know is that there had been all relevant factors had been put to reasonable consideration, and that the long term was not being sacrificed for some short-term objectives, and also that decision-making was not being skewed through the incentives that are given to the executives, which can be short-term. I mean, there's been a great, fascination and affection for share-based compensation, but then we make a rod for our own backs, because management then are rewarded for thinking about the short term because we've tolerated that in their reward programs. So, string.
So,
string is the answer.
as an aside,
Measure it with string.
one of the things that I've done is, as people have asked me about Apple and the like, I haven't talked to anybody at Apple. I have no idea what they're thinking. But I said, look, it's not hard to construct an argument that the board of directors at Apple might make for hanging on to this cash. And it would actually have many potential moving parts. One, look, for all you know, they might be looking at some very interesting potential acquisitions. Historically, some acquisitions have worked well, other acquisitions not so much. But there's a level of deference that you'd want to give to a company like Apple when they say, we've got to buy something big to establish a major beachhead in an entirely new market. Then you look at their $160 billion in cash. The vast majority of it is offshore. Right? Yeah. It's offshore. Yeah. Repatriating it would involve a very large tax hit. Mm-hmm. If you think that some deal is going to be cut with Congress where the marginal rate goes from 35 to, I'll make up a number, 10 or 15, then the IRR simply on waiting, until the deal is cut and then repatriating is sufficiently high that you could say, look, we will cross that bridge when we get to it, but we sure know that now's not the time to cross that bridge when there's an opportunity that financing cost is going to come down. You could imagine that they've got some excellent R&D opportunities, although I got to be honest with you, it's hard to spend $160 billion on R&D, in their sectors.
Very attractive place.
I'm sorry, the risk is a very attractive place, but I could probably get onto your risk for less than $160 billion.
No, it's expensive.
And the other, that's right, I'd have to check, yes. And then the other thing that's really interesting is you look at that sector, and what you realize is that there are entire companies that used to be at the forefront of their industry 5 years ago that are now gone.
Absolutely.
Anybody remember a company called Nokia? Okay. Anybody remember
Rembe? BlackBerry and show them.
Yeah. Take out your BlackBerry. It's going to go to the to over here. Yeah.
Well, and also there's a company where the capital was not there. It was not there for it to thrive.
So product cycles can be absolutely brutal.
Yeah.
And in an environment where you're subject to that kind of technology cycle risk, and you have the history that Apple has of, as you pointed out, Microsoft saved Apple's hide. Yeah. Now it's Apple that can wind up saving Microsoft's hide. These are very, very brutal companies, and you may be on top of the world today, only to find yourself, begging for help, 5 years from now.
Yeah. Absolutely.
Yes, sir.
Joe, to actually dovetail on some of your comments, there'll be a question to Anne. I've actually written a number of notes on Forbes.com about this and followed extensively and very much agree that they should not be ratcheting up really beyond what they're doing very much. But if they had a lot more cash in the U.S. already, instead of it was the $35 billion, there's about 25% or so, it was at 70% of it. If they had $100 billion in the U.S., would that change your thinking about how much they should buy back stock? Because they are funding, they've tripled or they've doubled their R&D in the past 3 years. So it seems like they're fully funding all their R&D efforts off of current income streams. So it truly seems to be they don't need that cash for R&D. But if a large portion was still back was in the U.S., would that change your thinking?
I think the point, and Joe's dead right, on tax. Tax is a confounding feature of board decision making at the moment. And the big owners like CalPERS, we've not taken a position on tax. But decision-making is skewed by tax considerations, and I think it's long overdue probably for us all to step back and take a look at this. In the meantime, the issue about the US earnings, and it's because of a quirk of national tax planning in global markets. It's a bit like national regulation in global markets, but this tax barrier to the repatriation, the financial barrier to repatriating money to the US, I don't, Tim Cook was there for the first time. I'd ever seen him in a suit, actually. Very smart, I thought. But he was there in front of Congress testifying on this issue, and it's obviously something that's of keen importance to public policymakers, and it's not resolved. So for them to sit tight on that money and see if it gets resolved, that seems to me an entirely reasonable position. If they had more money domestically, all you've done in that then bit of the question, oh sorry, you sat down, I was looking where you go. All you've done is neutralise the repatriation on tax. Then you've got to get straight back to a proposal where, do you want a proposal such as Carl Icahn's now withdrawn proposal, which said there is an amount and there is a mechanism and there is a deadline. And that really means that you're willing to box the board in on a decision where you simply cannot have all the information that's needed. Never mind all the expertise and the judgment that needs to be applied. So even if they were sitting on oodles of, dollars up to the ceiling, I think we would still be very troubled by a proposal that said, give us this amount by this date in this mechanism. Because, again, that's the job of the board. So if Carl Icahn or somebody with a better idea wanted to run for the board, was elected to the board, or wanted to sit down with the board and bring their ideas forwards, I think that's terrific. And I don't have any suggestion from Apple or from him that both sides weren't willing to sit down and talk. I think good ideas are always welcome. But really, a shareholder proposal for an issue for that like that is just, to our way of thinking, it's just simply not appropriate.
Other questions?
As I understand, you think the position of stockholders to a company should be elect or eliminate the board of directors. You don't feel it should be in some sort of attempt to guide the board of directors constitutionally. You can talk to them secretly, of course. And you don't think it should be in any attempt to guide the company morally, except as it returns value through money to you, right?
No, that's not how we view it. We have a concept that there is human capital and physical capital and financial capital. We don't provide the human or the physical capital, we just provide the money. And we think that the job of the board is to be a steward of that.
All three or just one?
No, all three, because
Okay.
we understand very well. So, and then there is a debate about what's our proper job in holding the board accountable for that, and that includes ethics and integrity, and doing the right thing is a fundamental intangible in all business. It's not something you can measure with a stick, but it's absolutely fundamental to what goes on in companies. I mean, you look at we won't go into examples, but there are plenty of them if we want to get, to go there. But companies where, a collapse of ethics, a collapse of integrity is the fundamental problem that led to the difficulties the business has got. Now, what we're interested in now is this issue of corporate reporting, because financial reports are backwards looking and they don't capture information that would tell you how a company is doing. For example, on human capital. I mean, the SEC has recently made an effort to capture a little more information about pay throughout the company. There's a rule that's been out on the pay ratio, which we've supported, not because we think that number's going to be some blindingly comprehensive insight into how people are being managed. Maybe it's more of a hook onto which you can hang a whole conversation, asking about what's going on with the proper management of people. And you can see it in absolutely every industry. Whether you're in a high-tech industry in California, talent management is just as relevant if you're in a global supply chain where you're employing people, and you need to be sure that even though the law locally or practice locally may allow it, you need to be sure that that company is behaving decently and properly. And it doesn't matter. So, at CalPERS we feel very, very clear that the value in companies does not just come out of cleverness with money. We actually have to understand corporate responsibility, and we have to foster that culture and be owners who are willing to ask those questions and to encourage that behaviour by companies. And that means being long-term, and it means being attentive to all of the parties who rely on the company to prosper.
One last question.
We have something in common. Apple is my largest holding too, but we could take your share and divide it by 100,000 and we'd get near where I was. I'm not happy with Apple's board. I get up every year at their meeting and tell them that. The two poorest vote getters are Andrea Young, who screwed up Avon, and Al Gore for the past couple of years. Don't you think there ought to be a mechanism for clearing out that rather entrenched board?
Well, with respect, there is. That's what the majority voting rule that's coming to the vote at this meeting will allow. Until Apple amended its articles, and they'll be voted on the 28th of February. The articles did not require that directors step down if they lose a majority of the votes, or they don't win a majority of the votes to stay. So should your view be shared by fellow investors, yes, all and any members of the board can be required to step down. That was not the case until quite recently. So that's why good governance, these what often feel like rather, they're not thrilling and interesting procedures, but the importance of information, timely reporting, the importance of board accountability, these are absolutely the foundation of good governance because they allow boardroom members to be removed. Now, this last year that just went by, we focused on a number of boards where we saw real failure. And an example is JP Morgan, where CalPERS and others really wanted the three members of the risk committee who had, in our opinion, did not have the banking, the international or the regulatory experience to fulfill that job. It was made clear, painfully evident, that they didn't have that ability when first the losses in London, the derivatives trades came through. And of course, since then, there's been a sequence of other losses. Of course, all of this is paid for by shareholders twice. First time when you lose the money, and second time when you pay the fine for having lost the money. So it's not a very, very comfortable position to be in. So, two of those board members at JP Morgan stepped down. They won over 40% of the vote against them, which is a huge number. Mr. Crown, the third member, has stayed on the board. We think he should step down too. We also, with others, felt strongly that there were directors at Hewlett-Packard who should go. After 3 failed acquisitions, lost us collectively $18 billion. And again, these are not bad people. They're charming. They'll be lovely company at a cocktail party. But they were not on top of their game. And it was made evident to us. Maybe we should have been there a bit sooner. But, having then identified what the problem is and said we need new board members, then we want people to step down. And again, 2 went, 1 stayed. But, I think shareholders are getting much, much more serious, not about a protest vote, but about actually being willing to move in and hold boards accountable. And that might be painful, but it's such an important discipline in the capital markets. It's not a game for amateurs. This business of capitalism is something upon which we all rely. And we must have people on boards with the talent, the ability, the integrity, and the independence. For that reason, it's very appropriate that this meeting is sponsored by the NACD. I have the highest regard for the NACD. And, pay good attention to what they're doing. They're leading the way on much of this work.
So, Anne, I'd like to thank you, and I'd like to suggest you probably caused many of us in this room to think differently about it. You're terrific. Thank you.